Hello and welcome everybody. Welcome to 2023 and welcome back to Sectors Made Simple. It's a pleasure to be back here with you all once again as we continue to make investing simpler for everyone. This week, we're going to be having a pretty big announcement on Thursday. Well, not we as in Sectors Made Simple, we as in the economy and the US. So Thursday, we're going to be getting December 2022's CPI inflation numbers. Now, inflation is something we've talked about a lot in past webinars, and today I don't want to go through the details and the minutia of what CPI is, the differences between CPI, PCE. Instead, what I want to do is I want to focus more on the stock market side of it. I want to talk about how these inflation announcements and economic data as a whole impacts the stock market. We understand that there is this connection between the market cycle and economic cycle, but sometimes that kind of gets left in just the textbooks or in our webinars. I understand you might not remember everything we cover in these webinars, and that's okay. But what I do want us to be able to talk about is strategies. Strategies are something that I wish to cover a lot more over the coming months, and before we do, we need to understand that strategies rely on clear weather. If we're going to talk about analogies, which I'll get into one later, it's like trying to follow a cookbook. But what if your oven can only do 500 degrees and your stove can only do high? It's going to be a little bit tricky to follow that recipe. So today what I want to do is I want to take inflation as a way of studying what these economic releases mean for the stock market and how that impacts our ability to use and follow strategies both short-term and long-term. I've done a bunch of data, a bunch of analysis, and I'm here to make it all simple as we try and understand why all of this matters to us. So enough about the intro, let's get straight on today with today's presentation, which is all about inflation strategies and you. We are trying a little bit of a different setup, so if you notice, I am down here now. Magic. There might be a slide or two that my face covers it. If that happens, I'll do a little bit of a duck and we'll make it work. But hopefully the new setup works for everyone. Let's get started by reviewing our quick disclaimer. Today I will be talking quite a bit about historical returns. I will be completely transparent in what this data does and does not do for us. But please remember, everything I'm sharing today is an educational resource and should not be financial advice. So please do your own research. I've done mine to try and help you out, but I encourage you to do your own research and come to your own conclusions prior to making any investment decisions. Let's now get started and talk about the goals for this webinar. Right now, which if you're watching this live, it is January 10th of 2023. Happy New Year. The stock market has been made or broken based on economic data releases. And by that what I mean is we are constantly getting new information about consumer spending, about how much our dollar is worth, and really what is that dollar going to be able to buy us. Now, some of this data is extremely valuable to us. And in fact, we're going to be getting another release of one of the most important, in my opinion, pieces of data, inflation, coming up this January, should be 12th, not 13th, Thursday, January 12th. Now, reactions to these updates are mixed. The market undoubtedly has a reaction to it, as I will prove later on. But how we react to this and how the investing community reacts to this does impact strategies. Not directly. After all, if you're using the matrix strategy that trades week over week, what we're going to look at today is a matter of days. But any strategy that you're using, you are most definitely going to be looking every single time it trades. Did it make you money? Did it lose money? Did it beat the market? Did the market beat you? You're going to evaluate it on a week-by-week basis. So today I want to talk about some of the reasons why these economic releases will affect our strategies, any strategies. So to do this, we're going to look at how the market has performed in the days prior to and after different inflation data releases, and we'll take a look to see if there's any change in volatility that we can study there as well. Again, it is going to be a lot of data. I'm here to make it simple, so bear with me. Let's quickly start off with strategies. Now, I think you all know what a strategy is, so I'm not going to bore you with a strategy as a way of trading that you follow some rules. No. We're going to use an example to explain why we care about it in the context of today's webinar. Strategies are a recipe book. You have a recipe book, and it tells you what you need to do, step 1, step 2, step 3, to make this dish. These strategies give us those steps to help us trade a certain way. Now, the recipe might ask you to cook something. It'll say, now over low heat or medium-low heat, saute vegetables. Oh, darn, I'm getting hungry. But why this matters is that imagine if you have the directions saying, cook over low heat, or put in the oven at 250 degrees Fahrenheit. About 130 for those that choose to use the correct metric system. But what if instead of being able to say, put your stove on low, or your oven at 250 degrees, your oven could only do 500, and your stove could only do high. That can happen with strategies and the market. We can have a situation where our strategy is telling us, cook over low heat, and all we have is a raging bonfire. It's going to kind of be a little tricky to do. So that's why it's pretty important for us to be able to understand a little bit more about strategies and how they interact with the market, because they really do interact with the market. It's not this, you follow this magic formula and you make money. I wish it was. Then make all of our jobs pretty easy. Strategies usually rely on something. What they rely on is either technical or fundamental analysis or combinations of the two that in the past have been signs of success. There's a reason that if I want to tell us how is the matrix strategy doing, I don't tell you it's done well. I go to the matrix, I go to backtesting, and I backtest the darn strategy. That is how you're going to really see how the strategy has done in the past. What good is someone telling you, hey, this recipe is really good, try it, if you don't see what it looks like, if you don't know what you're making? So strategies are very similar. They will follow some rules, and those rules might follow technical analysis or fundamental analysis. And hopefully the strategy can say, using backtesting or some other way of proving that it's a good strategy, that it's been successful. But we need to understand this. The stock market is not predictable. I think we all know that. You have a better chance of just flipping a coin than you do trying to decide if a stock is going to go up or down. Now, when it comes to building a strategy, we can't rely on the market being predictable. But what we can rely on is trends. If we were to use another example, I love examples here. It's the ocean. You have waves, which are these big ups and downs at any point. And those could be pretty big waves. They could be pretty small waves. Those are the changes in the market every day. We have very little control over that, and we have very little control over knowing, is there going to be a really big wave that's going to bounce us on our butts? What we do know, though, are tides. We know that the water rises at some points in the day, lowers at some points in the day, goes this way for a while, and then goes this way for a while. That we do know. That we can study, and that is very easy to track. let's put this into the sense, or into the terms of the market. The tides are the trends. These are things like cyclicality, this idea that there is a market and economic cycle. Then there's also seasonality, the idea that certain industries do much better in certain months. For example, how much business do you think a ski resort would get in the middle of the summer? Sure, they're going to do their best. There's no snow, so what they're going to do is they're going to have hiking, mountain biking, all sorts of things that you can do in the summer, but it's a ski resort. Their thing is skiing. It's not an outdoor recreation resort. It's a silly example, but that works for a lot of different sectors and industries. There are well understood trends of what industries and sectors do well in what months. Just like we know there are these market and economic cycles that span over years or even sometimes decades that show us periods of growth and periods of not growth or recession. These are not, we can't change these. These will happen no matter what. But those are the tides. The waves still will come and go, and those are a little bit harder to predict, but we know that the waves will be bigger during certain things. Let's bring things back to our strategies. Cycles we can build a strategy from. Meb Faber's sector rotation strategy. What inspired much of where we went with Sectors Made Simple. Relied on trading sector ETFs every so often and changing what you're investing in depending on where we are in that market and economic cycle. There are other strategies where you can invest using sector rotation, but using seasonality. In the Stock Traders Almanac, there's an entire list of what sectors and industries do really well between the months of October and March. But we need to also remember this. Our goal with the strategy is not to find the strategy that is 100% of the time profitable. Our goal is to find a strategy that wins more than it loses. I think a great example of this is if I pull up the strategy for the matrix. We go back here to January 6th. We'll end it now. One sector, rebalance every week. X count momentum, 2 or more. If this strategy is crazy to you, super easy. We have a webinar that we did at the end of last year covering this. And that's not what I wanted to show you. This is. All right. Okay. So, over the past year, this strategy made 12%. SPY lost 18%. Pretty good. What happened here? In fact, let's just zoom in on that. We're going to go to August 4th through the end of October. Strategy did not do so hot. If we pull this in even more, what we'll find, strategy didn't do well at all during these 2 weeks. But here's the interesting thing. Now we're looking at a matter of a little bit over a month. If we pull this all the way back, 2 years, and actually let's expand this to current. Things start to get a little bit more context. So Oh, there's someone saying, esta estrategia es la que no entiendo. Okay. Esta estrategia está comprando en esta manera. Cada jueves, esta estrategia está mirando aquí en el matrix. Más abajo del matrix tenemos momentum. Aquí necesitamos saber el momentum para hasta 2 semanas. Si haces clic en esta opción, vas a ver cada cambio por el matrix hasta 2 semanas. Necesitamos saber qué sectores tienen un X-count momentum de 2 o más. En este ejemplo, por favor, este es con información de hoy, no es con información de jueves. Esta estrategia está usando el matrix de miércoles y está comprando y vendiendo sectores en el jueves. Pero por este ejemplo vamos a ver esta información. Cuando la estrategia va a comprar un sector nuevo, vamos a mirar el momentum y estamos mirando qué sectores tienen un X-count para 2 semanas de 2 o más. En este ejemplo tenemos 5. Pero el mejor en este ejemplo es XLQ. Ahora la estrategia va a comprar XLQ y si ya tiene un sector desde la semana pasada, la estrategia va a vender esto y va a comprar el nuevo sector. Una vez más, en este ejemplo, porque XLQ tiene el mejor cambio del X-count y este cambio es 2 o más, la estrategia va a comprar XLQ. Después de esto, la estrategia va a esperar por una semana y en la siguiente jueves va a comprar un sector nuevo. Por más información sobre esta estrategia, tenemos un webinario desde diciembre. Pienso que el nombre fue... voy a buscar por esto en el sitio de Learn. Mientras tanto, vamos a seguir esta presentación y voy a encontrar el enlace para ti. Pero si necesitas ayuda con esta estrategia, por favor envíame un email y puedo ayudarte. Ok. Aquí es el webinario sobre esta estrategia. Ok. To review really quickly, where we're at so far with this is that any strategy is not going to be perfect 100% of the time. The matrix strategy is not perfect 100% of the time, as we see here. There are periods that the market beats it pretty handily. But our goal is that we do better more often than we do worse, and that over time we profit. With that said, let's now start taking a look at some of the data that I've prepared for today's webinar. And let's start off by asking, does volatility matter for strategies? After all, it's a good question. If these strategies don't change, they don't think, they just do. Again, this matrix strategy, it doesn't think, it doesn't decide how it's feeling that day. All it does is it says, it's Thursday. I look at number over 2, or number 2 or bigger, cool, buy. That's it. It's simple. But does volatility, this idea that the market prices can be changing a lot faster or slower at any point. Does that impact our strategies? What do you think? You think yes? No? Or sometimes? Sadly, the answer is sometimes. Because it really depends on the reason for that volatility. In a calm year, we have to remember that volatility is not flat. It will still have peaks and dips. But there will likely be less of those peaks and dips, and how big those peaks and dips are will be smaller. It's like going to the beach on a beautiful sunny day. The waves aren't going to be very big, and they're just going to be tiny little ripples. If you go out there and there's a thunderstorm or a hurricane, those waves are going to be really big. Some of them are going to be huge. That is higher volatility. So we got to remember that volatility can lead to some pretty big waves, but it is not directional. What I mean by directional is that higher volatility doesn't mean that prices are tanking. What it means is that prices are changing more quickly. So volatility is not how much the price changed, it's how fast or how unpredictably it changed. It looks and tries to say, how confused are people? You know, sometimes when you look at someone and they have that just look of, it looks for that. It looks for the I have no idea what I'm doing face. And the more people that have that face, the higher the volatility will be. The first data that I want to show you is if we take a look at VIX over the past 6 years. What we can do is we can find what the average of VIX was for each one of those years, and then a number called the standard deviation. Standard deviation is a nice big statistics term to just say the bigger the number, the wider things were. So, for example, in 2017, the average VIX was 11, with a standard deviation of 1.35. The simple explanation of that, 15 is what we consider to be a stable market. Anything above 20 is a volatile market. Standard deviation just tells us the bigger that number is, the wider or the more ups and downs there were in the VIX for that year. So 2017, not eventful. We're going to skip 2018. We'll come back to you, little problem child. We're going to go to 2019. 2019, an average VIX of 5.4 and a standard deviation of 2.6. Remember, the higher the standard deviation, the bigger bigs and lower lows there could have been. Now let's go back to 2018. Yes, the VIX was 16, but the standard deviation was 5.1. Meaning, yes, it was still a stable market, but there were some times in the year that it was not a stable market. And I think one of the easiest ways to show this would be just to open up the graph for that year. So let's go quickly to stock charts. And we're going to go here to sharp chart. Oh no, we need to go to per charts. And we're going to look up VIX. No, you can load the chart. I believe in you. No, we can't. All right. Let's see. Why are you being difficult? We're going to go to Finance Yahoo then. Round 2. Okay. So we're going to look at 1 year here. And we're going to go back in time. Here's 2017. The VIX everything here fits between a low of around 8.5 and a high of around 16. This is 2018 in comparison. There was a point in 2018 that the VIX hit 50. That is where that standard deviation is coming from. So if you don't want to think about standard deviation and all the math behind it, just think about it like this. The higher the standard deviation, the more times you'll find something like this, this, and this. You'll find a lot more of those big spikes in volatility. Looking at 2020, we get a really good idea of just how crazy that can get. The average VIX in 2020 was 30, double what an average market would be, with a standard deviation of 12. 2021, things calmed down again. We came down to 20, still not an average calm market. And our standard deviation was still a little high. 2022, things heated up a little bit more. Our VIX went back up, and our standard deviation went back up. If you don't care about the numbers, let's turn this into why you should care. 2020 to 2022 have been volatile years. While there is no connection between volatility and returns, remember, we said that volatility does not mean you're losing money. 2021, 27%. 2020, 14%. VIX doesn't have anything to do with if you made or lost money had you invested in SPY. But what this does tell us is that in 2022, we had a very high VIX, but a pretty moderate. 4.2 is not high compared to 12 or 5. So what that's saying is VIX was really high, and it was consistently high throughout the year. Market volatility was very high consistently throughout 2022. And that is part of the reason why strategies in 2022 were really hard to follow. If you got started investing with strategies in 2022, you might have been pretty nervous seeing these crazy days or these crazy weeks of losing 5 or 6%, making back 6 to 8%, and everything in between. It's a lot. And remind you, that's not normal. Normal is what we saw back in 2017 to 2019. But there's another element that we haven't talked about here yet. Atmosphere. Let's face it, investors can be a little dramatic. We like making a really big ruckus, even if there's nothing to make a ruckus about. We like a little drama in our lives, all right? One way that we can try and get an idea of how investors are feeling is the AAII investor sentiment. Oh. Show of hands. How many people here are bullish in the stock market? How many people are bearish? You? Oh, thanks for coming today. You? All right. They'll ask investors, are you bullish or bearish? Do you think the market is bullish or bearish? And depending on the answer, they will say 30% of investors are bullish. 80% are bearish. And they will update this number over time. Currently, as of, I believe the last publication we got from them was January 5th was the last one we got from them. 20%, 1 in every 5 investors was bullish about the stock market. Okay. Is that bad though? Well, in 2022, the worst it ever got was 16%. 1 in every 7 investors was bearish about the market. But the long term, 1 in every 6, my bad, not 1 in every 7. But the long term average is 37.6%. What that means is that we shouldn't expect, in fact, it is expected that the majority of investors that you ask are going to look at the market and say, I don't like the market right now. If we want to just boil it down to just simple terms, do you like the market or do you not like the market right now? The average is 1 in 3 people will say that they like the market. So when you think about it like that, it's going to make sense that you're more likely to see people panicking, or you're more likely to see people that are super negative, because the majority of them actually are. The data backs that up, that the majority of people look at the stock market and say, I don't like it. And here's the graph. It's not like we have big spikes and dips. It's pretty consistently, even through some of the better markets that we had, it's somewhere in between 20 to 40%. Kind of the same when a financial advisor asks to see the risks of your investment. Financial advisors are incredible for what they do. Their ability to understand risk versus reward is impressive. And unfortunately, that is a world that I cannot really speak much to. What I can say is about this data. Oh, my camera ends there. What I can say is about this data is that basically consistently, there's only been one period in the past 5 years that investor confidence has gone above 50%. The average long term over more than 20 years is 37%. I think we need to find out a strategy for this forecast of the market. Great question. It's tough. It's really tough for a couple of reasons. One, these markets don't last. I'll kind of spoil a little bit of my ending opinion just right now because you're asking. The reality of it is that we need to look long-term at strategies. Unless you're only planning on following a strategy for 1 year, markets always recover. Historically have always recovered. And securities tend positive over time. Bear markets are always shorter than bull markets, and bull markets have always superseded where the bear market left them. So it's tough because it's this whole idea of we know the market is going to turn around. It's not a matter of if, it's a matter of when. And the worst thing that we can do is not be ready for when it starts to turn around. Now, when it turns around, great question. If I knew the answer, I'd be a millionaire. We would all be millionaires. The answer to that is impossible. So that's why what we need to do is understand the short-term risks and understand that we can do our best to mitigate those risks in the short term. But any strategy that you use, especially one that relies on shorting securities or involves wanting things to go down, it's really tough to do that because at a certain point, things will stop going down. And we never know when that will actually happen. They always say you never know where the bear market bottom is until you hit it. It's true. You never know where it is until it's already passed and we're well on our way to recovery. So I think we need to find out a strategy for this market. I agree. That's the $1 million question though. And that's why we try and do things like update the strategies, why we want to start playing with more things like machine learning for our strategies, ways of not completely throwing the strategy away, but making little changes to it so that it can do better in down markets or do better in recovering markets. Great question. Honestly, if I had an hour to talk about just that, I would have a blast. And honestly, over the next couple of months, as we talk more and more about strategies, we will have a lot more of those conversations. So thank you. You got me on a big tangent that I would love to continue going down. Unfortunately, we've still got a lot of stuff to cover for today. So let's continue on this. Again, I'll talk about that all day if I could, though. So again, investor confidence. What this is telling us is the majority of investors don't like the market. So when we think about what people are saying, when we look at people's opinions, when we read articles where someone is expressing their opinion, we have to remember that 2/3 of the people, on average, will not like the market. And because of that, they will probably not be saying many nice things about the market. So again, investors tend to be more bearish than bullish. And because of that, investors are more likely to not like the market than they are to like it. And as a result, when there is negative news, they will react more to that negative news because it's like, see, I told you, see, the sky's falling, than they will positive news. Oh, well, yeah, it's raining, but that's just today. The sky was falling yesterday. I think I've covered enough about all of this background stuff. Let's get into the main topic for today, inflation. Inflation is tough because we have to ask the question, does inflation affect the stock market? Well, it doesn't directly affect the stock market, but it does affect it indirectly. And this is where things get pretty wild. Because remember, there is this whole chart, this whole, where's my chart? Oh, great. All right. Well, the chart's going to pop up in a second. This is going to be a little bit of a messy slide. We'll go through it though. The stock market cycle and economic cycle are connected. The stock market cycle comes before, about 6 to 12 months on average, before the economic cycle. So why are we doing it in reverse? Why, if the market comes before the economy, why are we looking at inflation, the economy, to tell us what we should think about the market? Think about it like this. If you want to know how well your kid is doing in school, you'll get report cards. These report cards are the economic data releases. Those are more test scores. The report cards are what we get every quarter. For stocks, we get 4 report cards a year. We get their 3 quarterly earnings reports and then their annual earnings report. Economic data are the homeworks and the tests and all of the things that tell us what the economy is doing, how the economy is feeling. Not every time we get a report card. Instead, it's constantly giving us more and more of this information to help us understand more about how the economy is doing. And then we can bring that back and say, all right, now we know how the economy is, where the economy is, where's the market? This was the chart that I wanted to show earlier. In orange, over here, we have the market cycle. And then in blue, we have the economic cycle. As we can see, the orange wave comes before the blue wave, meaning that the market cycle leads the economic cycle. Where does a bull market begin? But in a recession. Bull markets begin in recessions because the market begins to recover before the economy begins to recover. And that's the difficult part about when we want to try and find strategies that make you money when the market goes down. Once we're in a recession, we're already likely on our road to a stock market recovery. So it's tough. There is no real right answer. But is any of this even the right way to do it? Is looking at economic data the right way for us as investors to try and decide how we should feel and what we should think? No. Except for one case. Yeah. Again, the stock market leads the economic cycle, so it feels weird to look instead at the economic cycle to try and tell us where the stock market is. But the thing is that we are investors, but we're also people. We live in houses, we have jobs, we need to make money because we have things that we need to spend money on. And then, yes, at the end of the day, we have investments as well. Economic conditions, both positive and negative, will impact investors and non-investors. Because of that, if we get negative economic news, there's no reason for us to just start saying, oh, well, that's the economic cycle, and that means that we're already in a bull market. No, you're going to look at that and you're going to say, well, darn, my grocery cost just went up 12% this month. Or you're going to look at it and say, wow, gas is $7 a gallon. You're going to look at the things around you before you start thinking about some textbook definition of market cycles and economic cycles. But now, let's quickly talk, well, not quickly, but let's now talk about inflation. Because this is probably the most followed and impactful piece of data that we get. In very, very simple terms, again, I don't want to start going through all the different types of inflation and whatnot today. We just care about one. Headline CPI inflation. Compared to the same time last year, how much has the price of stuff gone up? Small amounts of inflation are healthy. It seems silly to say, but we want small amounts of inflation. It's the reason that we are encouraged to spend. If you know your money is worth more today than it is tomorrow, you're more likely to spend it today. But things above 3%, not as healthy, not as good. Because, sure, costs going up is not the worst thing ever if you're making more money, right? So wages went up by 8% too, right? That's where we get into the problems. Since March of 2020, inflation rose well above 2%. Back in March of 2020, it almost hit 0%. It is possible for it to go negative, by the way. And in May of 2022, it peaked at 9.1%. So something that cost you $100 May of 2021 would have cost you $109 May of 2022. So inflation is 3 times higher, or was 3 times higher than what is healthy. So what can we do about it? Well, now we get to talk about the Fed. Again, we're not going to go into a lot of detail. We've done that in the past, and it doesn't matter for today. But quick explanation, the Federal Reserve, or the Fed, is a government organization that helps to regulate monetary policy in the United States. They have a number of ways that they can try and do this, but the long and short of it is they are the people that we look to say, hey, inflation is too high, do something about it. Hello, Erica, good to see you. But it's not as simple as the Fed snapping their fingers and suddenly inflation is gone. Trying to fix inflation comes at a cost. It is not something that you just get to decide. It is now a solved problem. It costs something. And again, we're not going to get too far into it, but here's the main takeaway. The reason that investors are losing their minds right now is because they're worried that the changes that the Fed has made, that the way that our economy is headed, is sending us into a recession. I've covered this topic again lots of times. We've looked at the economic data to try and figure out where in the market and economic cycles we are. Let's just cover the reactions, the investors' reactions and the stock market's reactions to inflation. So the question is, are investors reacting to inflation? It's very, very likely they are. I can't promise they are, and I'll explain why shortly, but it's very likely that they are. Before we do, it is very important to remember this. Investors don't just bet on if inflation is currently going up or currently going down. For anyone that has ever done any sports betting, you don't bet on what team is going to win, you bet which team is going to win and by how much. So there are forecasts and estimates that different groups and analysts will say, we think inflation is going to go up by 0.2%. And then investors start to decide, do they think it's going to be more than 2%, less than 2%? They're probably going to, those active investors are going to start buying or trading options based on what positions they feel are the best. So it's going to start getting pretty hectic. Because again, they're not just betting on if inflation is going to go up, they're also betting on the uncertainty of that inflation. Let's take a closer look. There was a quick question, Jonathan, do you think investing in gold, bonds, and other ways of avoiding a loss from inflation is a good idea? Great question. Not a financial advisor, not a financial planner, not authorized to tell you if it's a good or bad idea. My opinion of them, they are very safe long-term securities, but the problem that you're going to run into is the fact that because inflation is so high, bonds are very tough. There's this whole idea of a bond yield curve, the idea that long-term bonds should have higher yield than short-term bonds. And that's not the case right now. Because of the way that the economy is currently positioned, we have an inverted bond yield curve. Pull that up. In regards to gold, again, long-term investment, that's very, very safe. Gold is never going to lose its like physical value, but the problem is that gold is going to be more static. It's not going to benefit as much from fluctuations in the market. So it would do better in a declining market as opposed to a recovering market. That's actually a topic that I will be covering more about in the future. Right now, what I will say is that any sort of bonds, either inflation-based bonds or standard yield bonds, are going to have a lot of risk not because of the bond itself. If you're just comparing it to cash, it's still yield. It's not, you have to worry about the bonds defaulting, but it is in a situation where bond yields are not good. Here is the bond yield curve, basically showing the yield of a 10-year bond versus a 2-year bond. Positive means that the 10-year bond is giving you more return than the 2-year bond. Right now, that's negative. It rarely goes negative, and when it does, typically a recession has followed. So, great question. Simple answer is I can't really say. I'm, again, not a financial planner. I can't really give you what you should do. In my opinion, if I were looking at it just as cash, cash is never going to change its value. Cash is cash, but inflation, the higher it is, the less that money is going to be worth. Any sort of treasury security is going to provide some yield. That yield is likely going to be less than inflation, is what I'll say. For things like commodities, like gold, whole different ballgame, something I'll cover in the future. But those are a valuable consideration. There's tons of gold ETFs out there that you can go take a look at their returns to try and understand a little bit more. As a quick just look, though, to give you why I'm a little bit more hesitant, is that the 1 year ain't bad, but if we look at where it was, it's not free money. There is no such thing as free money, especially in a market that's as crazy as the current market is. 5 years, again, it's not going to be something that you need to worry about losing your shirt, but the returns are not going to be anything that you're going to write to your family about. Great question, though. All right, so just checking out where we were before, we're talking here about inflation and talking about the fact that investors are going to bet on inflation, whether it's higher or lower. Now, we're going to take a look at some data, and the data that I've picked out for us to look at is each CPI update. We get one a month. All of the CPI updates since inflation went above 3% back in April of 2021. For every one of these updates, we'll compare the actual inflation rate against Trading Economics, who provide a forecast. Is their forecast the best? No. Is it the only one? No. It's the only data I had. It's hard to find historical data on stuff like this. Wayback Machine was the best I had. So, what we'll also look at is how SPY, the S&P 500 ETF, has changed in price from 2 days before the announcement to 2 days after the announcement. And we'll also do the same thing for VIX to try and understand how volatility changed. And the goal here is to see if we can find a trend between inflation and the forecasts compared to the market volatility and price. Quick few notes about the data. Again, I want to be transparent here about what I can and can't tell you. All of the data that I'm giving was from Trading Economics, and unfortunately, their forecasts are the only ones that we have. It's not that their forecasts are wrong, but I've gone into the past about why single forecasts are not something that you should be basing your entire argument on. Again, the data that we're looking at here will be between April 2021 to December of 2022. This is not a big enough data set to say this is a conclusion. This is not something I'm going to go out and write a book on. This is just, I was curious, I did this math for myself, and I wanted to share the math for you too, because it still showed some very interesting data. And also, we're talking right now about short-term things. We're talking about needing to and wanting to invest on the short-term level, and we care more about short-term performance between these 2 years. And again, This does not take into account things that aren't inflation. There's a lot for us to go over here. I'm just going to blast through the numbers and we'll just get straight to the conclusions. Out of the 21 dates that we tested, 5 of them had CPIs that were better than the forecast, 5% tied it, and 11 missed it. When the average return for SPY was shown, it was 0.26%. If the actual CPI beat the forecast, we saw an increase of 0.74%, and if it was worse, we saw an average loss of 1.2%. The average for CPIs didn't really matter. It didn't matter if the CPI was up or down. All it mattered was that the CPI was better or worse than the forecast. For VIX, a little bit of a different story. The average change in VIX was negative 1.6, meaning the market got a little bit more calm after the CPI data release. The average change if the CPI was better than the forecast was 4.6% down, and it went up if the CPI was worse than the forecast. If it tied the forecast, it was a drop of 5.9? Yeah, funny enough. So if the CPI change was positive now, we saw an increase of 1.7%, and if it was negative, we saw a loss of 5.9%. Jonathan, so no investment can be made at this time. Unfortunately, if I answered that question, it'd be financial advice, and I don't feel comfortable doing that. There are investments that can make money at any point. There's always a bull market somewhere. It just becomes harder and harder to find the worse the market is. The market right now is not the worst it's been. I'm sorry that's not really the answer you're looking for, but in my position, it's very difficult to give you the answer that you're looking for, just because there's a lot of rules and regulations as to what I can and can't say, and I want to be very far onto the side of knowing that I am saying what I can and avoiding saying what I can't. So again, I sincerely apologize that I can't give you a better answer. Again, I just rattled off a bunch of numbers. I just want to bring things back and focus more on why we care about what I showed. This part I will take my time on. The stock market does, to a small extent, react to CPI. The market's price had a very clear reaction to if the CPI was above or below the forecasts, more so than it did to if the CPI change was positive or negative. Going back once again to what I was saying about people are betting on if they think the CPI is going to go up or down. Or sorry, they're betting on which side of the forecast they think the CPI is going to go up or down. Volatility was the opposite. Volatility did not change very much based on if it was close to or far from the forecast, and instead changed a lot based on if the CPI was positive or negative, but overall decreased. And here's the big takeaway. The best situation for all of these examples, when it did the very best, was not when it was better or worse than the forecasts. It's when it tied it. The ties is where it did the best, where volatility went down the most and price went up the most. What does that mean for us? That means that what we hope for is not that we surprise the. It's not that we get a surprise that we did better than the forecast. It's that we are close to the forecast. And again, let's bring it back. Why should we care? No, I appreciate your understanding, Camilla. Thank you so much. Now we get into my opinion of all of this. The data here, there's a lot of it, but what it shows is that the market does have a short-term response to CPI data. If we only care about actively trading, you're trading options, you're day trading, or looking at short-term results, looking at week-over-week returns for a strategy, inflation matters to you. These inflation announcements will have an impact on the market. But if all we care about is looking at long-term strategy returns, buy and hold over months or years, we shouldn't be as worried or shouldn't be watching these announcements worried about what's going to happen to our portfolio. All of the trends that we've talked about are short-term. They all relate to short-term movement, and more long-term, these reports don't change the macroeconomic trends. Crazy words for just saying it doesn't change the big picture of things. It'll change things for a couple of days, but again, if a student is doing well in a class, just one bad homework assignment doesn't mean that they're not on track to do very well. Or if they get an A on one homework assignment and they're failing everything else, it doesn't mean that they're doing well. So we need to understand the whole picture as well. And again, why did we cover this today? Thursday, January 12th, is going to be the next CPI data release. As inflation continues to be a key talking point, this is something that investors and non-investors are paying attention to. We need to understand that these inflation updates for the past 2 years have mattered. And us understanding just how much inflation has mattered and how much it's affected the market over the past 2 years should give us a little bit of comfort to know that the market's not going to crash whenever we get a CPI announcement. And in fact, volatility almost overall goes down. If the CPI change is positive, it goes up. And if it's worse than it was expected, it slightly goes up. But the lows are even better. And again, the best performance we had was if it tied. If we got what we were expecting, we're happy. We care more about knowing the outcome than what the outcome actually is. And the reason I wanted to set all this up today is over the next few months, we will talk a lot more about strategies. Option strategies, standard stock strategies, ETF strategies, revising matrix strategies. And as we do, I want us to understand the whole picture. If we're going to be trading actively and start using more active and talking about more active trading strategies, understanding key things like inflation is going to be really helpful for us to get a more well-rounded understanding of what's going on. Again, I apologize if today was a very, very dense webinar. There was a lot for us to cover. I wanted to reconnect with all of you guys and get to talk about some data that I've been researching. I hope you found it interesting. And if this is something that was curious to you and you want to get more information, if you want to see the data that I put together to prepare all of these analyses, reach out. Again, this is stuff that I do enjoy talking about. These webinars I bring to you because it's research that I love to do. So I'm more than happy to share that research and the findings with you all. So thank you all so much for joining us, for bearing with me through a pretty math and numbers heavy webinar. I promise you we'll be back with some really fun strategies and ways to apply the knowledge that we've talked about today in the coming weeks. So thank you all so much. It's great to be back. And hopefully we'll see you all for our first live premiere for our video this Friday. Thank you all so much. Take care.